Morning, everyone, and thanks very much for joining. This is the morning market review. It's Thursday. It's the 29th of September. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address shaw@fxcm.com. Just going to bring up the high risk investment warning. I'll keep this on screen for a few moments. Hey, Howard. Morning to you. And morning to everyone. Thanks very much for signing in. We've got the second part of our day trading course a little later, and looking forward to that. Here's our market commentaries disclaimer. All right, and our references. I'll just bring up this chart here. I'm busy actually finishing off the Q4 report, which I've got I'm already a day late in submitting it. So I'm just doing the proofreading. This is one of the charts in the report. So I'm going to finish that and send it off this morning to compliance. Let's go through the Bloomberg email, 5 things to start your day. The first headline reads, crisis of confidence. Britain is in a self-inflicted financial crisis that threatens to accelerate the economy's dive into recession, and the country's new prime minister is coming under intense pressure to blink. In the week since the government unveiled the biggest tax cuts since 1972 with scant detail of how they will be financed, the pound has crashed to its lowest level against the dollar, and the Bank of England has been forced to intervene amid concerns about the nation's pension funds. What happens next will determine just how deep the looming recession proves. Second headline, new sanctions. The European Union proposed a new package of sanctions. The European Union proposes a new package of sanctions on Moscow that would ban European companies from shipping Russian oil to third countries above an internationally set price cap. European Commission President Ursula von der Leyen said the EU will propose a sweeping new import ban on Russian products that would cost Moscow 7 billion euro in revenue, as well as prohibit the sale of key technologies that would benefit its military. The new sanctions also would work to restrict the transfer of Russian wealth via digital assets like Bitcoin. Next headline, not going anywhere. Janet Yellen, eager to see through crucial projects, has told White House officials she's prepared to remain Treasury Secretary well after the midterm elections, according to people familiar with the discussions. Her desire to stay comes as White House staff begin to prepare for potential cabinet and other senior personnel departures or changes, including on President Joe Biden's economic team after the November vote. If she stays through next year, the ex-Federal Reserve Chair would provide stability to Biden's economic agenda should turmoil across energy and financial markets morph into a broader crisis. Next headline, bold move. Volkswagen set the final listing price for Porsche at 82.50 euro per share, valuing the company at 75 billion euros as it seeks to prove that the iconic sports car brand can sidestep the slump in capital markets and put up Europe's largest initial public offering in a decade. A meeting of VW's supervisory board and its executive committee late Wednesday approved the final list price, which sits at the upper limit of its range. Porsche will mark its first day of trading when markets open on Thursday in Frankfurt. So it's quite exciting. European equities have nudged up. European equity futures nudged up as Asian shares rebounded after the strongest day for US stocks since early August. Porsche shares start trading in Europe's largest IPO. It's a busy day for central bank speakers as several ECB governing council members address a conference in Lithuania, while the Fed's Loretta Mester and Mary Daly also attend events. Expected data includes CPI inflation for Germany and Spain, plus Eurozone economic confidence and consumer confidence. H&M and Nike are among companies scheduled to release earnings. Rob asking, I'm sure you'll get onto it, but was the UK gilt buying the main driver behind the US dollar getting weaker? So I think let's start where we always start. Let's start with the real rate and work from there. So we'll just bring up our 10-year minus the 10-year break even. And that gives us TIPS, Treasury inflated, inflation protected securities, which I'm not getting. Why am I not getting this? US 10-year minus the break evens. Yes, better. All right, so what you can see here is a sharp decline in the real yield, right? And let's throw in the US dollar. All right, and you can see we're on the daily basis, and you can see the correlation there. So let's throw in the correlation coefficient. And just see the correlation coefficient. I mean, on the daily, so we usually look at the correlation coefficient on a weekly, which is a remarkable 89%. But it's just as strong on the daily. So whilst you know, the buying of I think one of the stabilizing of the gilt market may have had some influence. It's really, I think, a function of what's happening on the US side of bonds. And what we did is yesterday, we take this off, we can throw in the RSI. And if we take a look at it on a weekly basis, we're still overbought on this weekly basis. In other words, the prospect of dollar correction must still be on the forefront. Must be on the forefront of our thinking. This is a weekly basis, right? So this is actually one of the key themes. It's one of the sort of topics I write about in Q4. In that, yes, we're in this tightening cycle. We're in this bear market. But I think Q4 is going to be complex because I think the prospect for a bear market rally must be considered, because on the weekly, this overbought condition, I think, should normalize. The problem with the weekly is it's difficult for timing because it can take weeks, obviously, to normalize. What happens if it takes 12 weeks? Well, that's the quarter, you know. So, well, 13 weeks, that's the quarter, right? So, but if you take a look on the daily chart here, take a look at this, Rob. It was a very intense overbought reading. So the normalization here is, I think, normal market behavior, and yeah, and we suggested it yesterday, right? So the idea is dips become compelling, except in this case, we haven't normalized. We haven't got that dip on that weekly basis. So, and if we just take a look at the 10-year, the 10-year was, the movement in the 10-year was just simply unrealistic. Okay, so you can see even just the plain nominal yield needed to come down. So effectively, what happened here is the 10-year bonds effectively have been sold down. Let's bring in IEF. So IEF's exchange traded funds, which is effectively looking at the 710s, right? Well, you can just take a look at how this has been brutalized. You know, it's been absolutely hammered. Well, one of the comments or suggestions earlier in the week, well, isn't that perhaps going to be perhaps compelling for bond market participants? Maybe they can buy some bonds here at ridiculously cheap prices at really good looking yields at the moment. I think it was Gerdie that actually suggested at the beginning, is there going to be some sort of movement in the bond market? Well, yesterday there was. Again, I don't know if this has legs or not. I don't know how far it will go. But the normalization here, I think, is not out of the ordinary. I would say that it's actually normal behavior. But where it's fascinating is, of course, on the weekly. The weekly on the 10-year is not quite as deep as the real rate, but the real rate's quite deep in terms of froth. So, and I think that bond players over here probably are sort of looking very carefully for potential entries because the yields are getting super, super interesting, especially on the high yield side, on the junk bonds. I think we're looking at sort of 8% there. I mean, so that's probably what's happening here. I think that the yields are looking frothy, and I think the bond market is where the adjustments potentially take place. But that adjustment in the bond market affects yields, and that yield has a whole cause effect that goes right through. So we bring up the real rate again. So we know that the dollar came down, right? But then we read earlier that, just go back to the daily, that the stock market had a superb day. So let's bring up the Nasdaq. Just bring up the Nasdaq because Nasdaq tends to be the most sensitive to rate movements. So let's bring that up. But we'll bring up the others as well. Let's take a look at Nasdaq first. Okay, so we had a really good day on the Nasdaq yesterday. So you can see the cause and effect. So in the Q4 report, I'm calling it the chain of causality. So we've got real rates, dollar, other financial instruments. You can actually take out the dollar, although the dollar is a sort of a key link in the chain. You can have real rates, other instruments, and you can see the Nasdaq here had a really good day. But take a look what's happening here. So now real rates are showing a blue candle. What's happening to Nasdaq? Showing some red. That's interesting, right? Bring up the US 30. Okay, so we've got similar. So this makes Q4 very interesting, but it also makes it, in my opinion, psychologically challenging for the trader, because I think that the potential for the pullback on rates, I think there is a lot of sort of potential energy there, so to speak. Whether it changes to that kinetic, do we see that potential actually pushing the yields down in a forceful manner? Well, then we have a significant bear market rally into Q4. And what's going to be challenging is just the news around that, as in we found the bottom. We found the bottom. We've had a terrible 2022. Q4 is opening up 2023 for us. 2023 is going to be a terrific year. And that's going to be the psychological challenge, in that is that true or not? Potentially it could be true. I mean, maybe the Fed decides, you know, it's time to sort of stabilize and maintain. There has to be some sort of key policy shift somewhere. Some fundamental has to change. And that's kind of the story. I think it is a very strong sort of probability in terms of news we get for Q4. If, and this is obviously the key, if we get the normalization in the real rates, of course, it can take the full quarter for the real rate to normalize. Could take, so we might only see it next year, but I don't think it'll take that long. But in terms of the timing, weekly charts are very difficult. However, what I'm wary of is that it may be setting up sort of for that final capitulation. In other words, we may not have seen that panic selling. I mean, we've had an awful year. So maybe we have seen the panic selling, but the underlying fundamentals still suggest uncertainty. They still suggest a danger. I don't think the Fed has met its objectives and is just writing out, you know, the median inflation is key. I think that median inflation, exactly as Anna said, that has to show signs of moderation. So any sort of bullishness into Q4 could be a trap, and it's going to be very difficult for all of us, you know, because bottoms are so sort of seductive. You know, we all want to try and get in right at the bottom, and each bear market rally, we all think it's the bottom. So they're very dangerous. Bear markets don't lose the money. It's the bear market rallies that lose the money. And I'm very worried that's what's going to happen into Q4, because exactly as Anna says, we haven't seen the change in the median. And she writes, we haven't seen any significant change in employment. So I think those are key variables to keep an eye on. But the markets are sort of setting up where there's this huge kind of potential. It's like an elastic band that's been stretched on the interest rate side. It looks really kind of stretched, and at the same time, the bond prices have been stretched to the downside. And as Gertie said on Monday, what about the bond guys? You know, they must be sort of smacking their lips in anticipation. So this dynamic is kind of setting up here, and I think it's a dangerous dynamic. How do we participate in that? Do we actually decide to trade in a counter trend? And if we do, are we savvy enough to recognize it's a counter trend? The same can be said. What happens if we choose not to participate and it is the bottom? You know, well, what do we do? So we're kind of getting, I think, into the end game. I think we are getting into the end game. I say that sort of more as a educated guess than anything else. Whether it is or it isn't, I don't know. So the obvious question is, well, then, how do we monitor it? Well, I think we've got to monitor it as objectively as possible. And the only way that I can think of that we can be as objective is, of course, with COPOC. So COPOC is actually sort of featuring quite a bit. I think in these webinars, and I just don't see another tool that quite has its track record. I mean, I like using a MACD histogram as well. That's something that I think it would be fair to use, but I think that the COPOC is something that we can just keep in our toolbox, and at some stage the bottom is going to be the bottom's going to be there, right? At some stage, I don't know when. Nobody knows when, right? We can just kind of make sort of guesses and summations and see if they pan out. But what we can do here is make this 0 and just add in that 3 month, right? Just adding that 3 month. We'll make it an exponential moving average just to give it a little bit of speed. I think this is it actually. Let's just see. That's the 3. Let me just make it blue. It's too much red there. Okay, and so we're going to be late to the bottom. So we're going to be late to the party. I think we've got to make peace with that. In other words, I don't know when the bottom's going to kick in. So sort of my hypothesis that I'm working on, which can turn out to be absolute rubbish and incorrect, is that Q4 is setting up for a potential bear market rally if real rates pull back. That's going to pull back the dollar, right? There's a chain of causality. I think we see real markets potentially benefit, and I think that we're all going to be bombarded with the news that we have bottomed, and it may be true. Maybe it's not a bear market rally. Maybe for some odd reason we have bottomed. Anna has made some very good points. Gertie writes here, Powell may talk Volcker, but he may roll over as Bernanke or Greenspan. Well, exactly. I don't know. I think the key here, Gertie, is exactly what it is written. I think in particular we want to see the median inflation rollover. But in terms of sort of objectivity, perhaps sort of we just defer to the COPOC, understanding and accepting that it's going to give us a late signal, but the signal is going to be pretty close to the bottom. It's not going to be at the bottom. It's going to be pretty close to the bottom. The other thing that we've got to accept is that COPOC can give false signals. Okay, so in other words, we may not be at the bottom. So you can't just willy-nilly go and start accumulating stock based on a COPOC signal. But what you can do is you can start looking more closely at sort of the underlying fundamentals. You can start looking at the underlying technicals, doing proper top-down analysis on both a fundamental and a technical basis. But it all comes from the COPOC turning up. And I think hopefully sort of we get that in 2023, and it turns out to be sort of an adequate precursor to hopefully the next bull market, you know. But that's about as good as we can do at the moment. The Q4 I think is setting up to be quite tricky. I think it's setting up to be quite tricky. All right, let's just do a few charts here just before I sign off. Let me just bring in this guy here. All right, incidentally, what I was looking at yesterday was the zones on a monthly basis, which I think is also a good way of looking at the charts. We don't do it all that often, but every once in a while, you know, maybe once every 6 months we kind of do it. But sort of the Nasdaq in zone 3, take a look where that momentum is. The longer that momentum stays in 20, you know, the harder it's going to be. What's going to be difficult is if there is some sort of Q3 rally, so we get maybe sort of another 2 bars here, right? Another 2 months of blue, and that ticks out of 20, and then the next capitulation pushes it back into 20. And that just plays havoc with your psychology as a trader. So so the idea here is we just want to keep an eye on this, but it still looks quite bearish. US 30 here, looking quite bearish, not quite as bearish as NASDAQ, but NASDAQ's much more sensitive to rates. Let's take a look at SPX 500, also looking bearish. Let's take a look at DAX. All right, so DAX is looking really fragile, isn't it? Take a look at the Bollinger's on the DAX. They're starting to push apart. That's not a good sign. However, if there is that counter trend move, DAX would be a beneficiary. So that's my point. It's a very tricky environment. And it's just asking, when does the Q4 report come out? I think so, subject to correction. I think 5th of October. Yeah, you'll just be able to download it. I'll let you know when it's complete. I've got to get it through compliance, and then I'll give you more information. But you should get an email just saying download our Q4 report. But if you don't get that email, just speak to me. I'll send it to you. But I need to get it. First of all, it's a Word. It's a Word document. It's a Word document, and it's all. So we've got to give it to sort of our designers. They're going to make it look really professional. And so we haven't looked at the Russell index. Yeah, we can bring up the Russell, definitely. All right, so it's in zone 3, and you've got that downwards momentum. But all of these indices, so the Russell and the NASDAQ would be the most sensitive to real rates, but all of them are going to be sensitive. All of them will be affected by rates, and that's exactly what's happening. So what we've got to see, I think, for a reversal, we've got to see, I think, the COPOC moving up. I think the COPOC moving up will suggest that there's a capital rotation, potentially a capital rotation from havens back into risk. But then we want to also see the interest rates either being sort of at the apex of the cycle, and even talk of sort of loosening. And behind all of this, just by the way, behind all of this is the X factor, which is of course quantitative tightening, which makes analysis extremely difficult. Because let's just say, so the current terminal rate is 4.6%. Okay, let's say we hit 4.6%. But we are siphoning $95 billion out of the economy every single month. What kind of an effect is that going to have on interest rates anyway? What kind of effect is that going to have on the capacity to move capital into the risk markets? It's a huge X factor, and it's unknown, it's unconventional. The reason that we in this situation where there is just a mass amount of sticky inflation, well, a large culprit has been the loose policy of the Fed, the liquidity. Again, I don't think that they had any choice, because we were dealing with a pandemic. I mean, I never in my wildest dreams, I don't think any of us would have thought about lockdown, and it sounds like out of a comic book, but so how do you react to that? But the point is, it's an untested economic, not untested, it's unconventional. Quantitative easing is unconventional. Well, so is quantitative tightening. So how that affects the whole analysis, that's a huge question mark. All right, I think let's conclude here. I just want to finish up the proofreading for Q4. I've got to get that out, and then I want to prepare for the second webinar at 11 a.m. UK, 12 p.m. ZA. So looking forward to that. Any questions? All right, let's wrap up here, guys, and I shall speak with you a little later in the day. Thanks, guys.